if we take a segue to capital allocation and also making it relevant for people who are tuning in, I mean, how would you sort of, go about the principles and how to allocate capital? Because, I mean, there's so many angles, age, risk profile. You do it as a professional job, others do it personally, right? So if we look at just capital allocation, what are like the main principles people should think about and consider?
Well, first of all, keeping your purchasing power. Let's go back to first principles, right? And we know what the long-term returns are in the United States stock market. It's 6.5% real returns, then you need to add inflation on top of that. And now we're talking about the last 125 years. So that gives you about 8 to 9% over the long run. The funny thing, in lack of a better word, is that the last 75 years, there's only been 4 years when the return on the stock market has been between 8 and 9%. Why is that? Well, it's not normally distributed. It's trying to. So you need to be able to survive that or mentally be able to do that. In our fund, what we're trying to do is doing that by having a low standard deviation around the return. So we're diversified on geographies, diversified on sectors. And I think from a Nordic perspective, if you're there, you also need to think about the currency. Right? So you have two alternatives. Either you want to hedge your currency, which is somewhat costly and could take away some of the returns. And it's a timing matter as well and rebalancing. This is a lot of, so we don't, in our fund, we don't do any currency hedging. But we have a kind of allocation to the Nordics of about a quarter and 20 to 25%. Why is that? Well, it's actually, if you do the math, it's better, assuming you live in the Nordics, for example, to have that allocation in stocks rather than doing the currency hedging. That gives you kind of a natural hedge. But another kind of key aspect is that the Nordics is like a mini world. If you're looking outside Norway, clearly in Denmark you have the healthcare industry, which is very strong on a global scale. Sweden, you have both industrial companies and technology companies. Finland, you have a lot of industrial companies as well with a long track record and good returns. So, it doesn't give you, luxury brands and all those kind of things, but it gives you a lot in the Nordics. So that would be my first thinking, having some there. But then at least what we do, we try to expand out from that on a balanced basis. If you just go ahead and buy, at least my first would be, save something, outside Norway. But the problem, if you do buy the world index, you end up with almost 70% allocation to one country, United States. Great companies, but it's had a heck of a journey the last 15 years and starting to become somewhat pricey on simple earnings multiple. So trying to find something more balanced than just going for that would be my idea on a personal level. And hopefully we can touch what should a company do in terms of capital allocation, which is key for the return of the stock.
Yeah. So another part before diving into what makes great companies. What are your thoughts on the debate on active versus passive investing? I mean, we have a fellow Norwegian, Robin Wigglesworth, wrote an amazing book, Trillions, where he dove into how the index fund was created. And what are your thinking of that debate, passive versus active? What should be your general, ideas on it? Super hard to beat passive, or is it okay, if you find an edge, possible, but extremely difficult?
I think on the passive side, I mean, it doesn't really fit with the original definition of passive, because it actually does a lot of rebalancing and trading in it, right? So it's not, but it's putting the semantics aside. I mean, how we think about a company. I mean, you're part owner of a business. In what other senses, if you own the local bakery or something, would you put away all your decisions to someone else? I mean, going back to first principle, owning stocks is owning a small part of a business, right? And owning a small part of the business, someone needs to make those critical decisions. So my key concern with that is that you get more management-run companies. That would be on the longer term, right? That's the one thing. And besides those other effects, as passive takes more, you first of all, you have clearly a momentum effect, right? Which can do something to the price allocation and price discovery mechanism. But I'm more concerned about kind of the governance angle from a shareholder perspective, as more and more money become passive or institutionalized in terms of voting, I mean, it become all sorts of issues, not just ESG I'm talking about, I'm more talking about, capital allocation, pay packages, all these kind of things which are important for shareholder return, not letting companies become management run, which I think can be an issue in the passive trend. So those are my 2 cents. But now I'm talking, running an active equity fund. So, you're getting the answers with all the biases coming your way.